This
Good-
meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
Yeah, we do. Good to see you. Good to see you. Thanks for having us.
Yeah, so video number one, we talked about CPI, we talked about core, we talked about really an uncertain future, but you know what? We have a Fed meeting in about 48 hours, or actually the Fed meeting starts tomorrow. In fairness, we have a Fed decision in 48 hours. And I thought I would ask you, what do you think they'll do? And what do you think they should do, which could be different answers. I know they are different for me. So we'll start there, and then we'll talk about
I know where you're going. I already know where you're going.
All right, let me hear you first. You are the guest.
Yeah. So I will go with the consensus right now, which is 75 bips, a 0.75% raise. There's, I think, a outstanding 15% chance that it's going to be a 100 basis point move, full 1%. I think that the Fed, and we talked about this on our last video a little bit, obviously is backed into a corner where they haven't been able to control inflation, and unemployment is stubbornly low, which seems like a good thing, but it just drives further inflation on the other end. But the outstanding kind of factor is that a lot of the economic data is weakening. And I know that's not part of their mandate. Their mandate is full employment and price stability, but I don't think they're blind to it. And I don't think the market concerns them right now because it hasn't come in enough to have a real concern on them. But I do think the economic outstanding kind of tertiary type effects are weighing on them at least a little bit. And so therefore, I don't think they want to slam the sledgehammer down at 1%. But I know you want them to. I know you want them to. So weigh in here.
Yeah, I think you've nailed it. I think they're going to go 75. I think Powell is proven to be the tell the market what's coming, give them what they expect guy. But you're absolutely right. I want them to do 100, a full basis, a full point. There's a little hope I have because, again, Jackson Hole was not what the market expected. That's the first time I think he did something the market didn't expect. I think there's a small chance that he wants to continue that. And really, what did Paul Volcker do? He clearly told the market he's in charge or not. He didn't listen to the whining. He didn't change when the market went down 1,300 points.
He didn't listen to Elon Musk.
He didn't listen to
Elon
Musk.
Gunlock and
Kathy Wood.
Kathy Wood. That was the other one I was looking for. Yeah.
So yeah, he didn't listen to the 1%. Again, I've said on my daily financial show, the Fed wants to hurt the 10%, which I include myself in and you're in as well. The Fed wants to hurt us. The 1% get on TV.
Right.
The 1% are being hurt disproportionately, as they should.
Right.
And
because they own all the financial assets.
They own the damn assets.
Right.
Right.
Like, they own the assets that the Fed's coming after. Pretty simple.
Full stop. And my hope, belief, prodding, prayers, tea leaves, do a point. Tell those son of a guns, I'm in charge, you're not, which would cause a repricing, earnings collapse. The dollar would shoot higher, which would hurt earnings, FX charges. It would shock the system, and it would be a wild day because this announcement comes out while the market's open. I think it comes out at 11:30 Pacific, 2:30 Eastern. The market's open. This is not it comes out after hours and they have 24 hours or 16 hours to think about it. No, this is bang them. The market would roll over instantly. And then you have the press conference and then just continues.
And that's what happened in Jackson Hole too, is that was a midday type event. And actually I disagree with you. And it's funny. Awesome. And I said this I said,
I like it when my guests disagree.
No. I disagree with you because I think when you look back to Jackson Hole, and I said this right afterwards, I said, I don't think they said anything different. I just think they were a little bit more blunt and less shrouded about what they were saying. So they came out and said, listen, inflation's out of control. We need to control it. We need to get it back down to 2%. That's what our mandate says. But then they just stopped. That wasn't anything new. It was just the fact that they stopped.
Well, what was new was what wasn't said. My belief, again, the Fed would talk about blah, 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 and then they would always leave a back door open.
Right.
The market was looking at the back door saying Fed pivot's coming, Fed pivot's coming, Fed pivot's coming. They didn't talk about the back door. Back door's closed. Back door's locked. So net, it was different, in my opinion.
I guess that's fair. Yeah. The messaging was the same, but to your point, maybe there wasn't that soft, but if, then what?
Yeah, exactly.
Yeah.
But this week,
on at the end.
I would tell you this, and I said this on my daily show. I think the Fed rate increase is the least important thing on Wednesday.
Yep.
The dot plot.
Just because you think it's already a foregone conclusion what's coming, and then you're just saying that the comments are what's going to be most important.
Well, actually, I think the dot plot is the most misunderstood,
okay, fair.
underappreciated thing, because I think the dot plot is going to crystal clear say how fast, how high, and how long. That's what the dot plot is. It has been a boring economic, battle for years. This week, that dot plot is the most important, even more important than the conference, in my opinion, because I believe it will be fundamentally different. It will be higher, it will be faster, and it will stay high longer. I think it's all about the dot plot. What do you think?
And I don't think you're wrong there. I think that last week what happened was that inflationary print opened the door window, whatever you want to call it, to a wide dispersion of different activities that they could potentially take place. The market right now is saying we have no idea what the Fed is going to do as of this past week. Literally in the last week, it shuttered, and the market does not like uncertainty. You hear it till people are blue in the face, but when there is uncertainty, people say, hey, I want to err on the side of caution. And with that, that's not holding risk assets. And that means driving stocks down further and further. So I don't disagree. I do think that the comments are going to continue to be important, because I think that he's going to continue to say, and he might come out and say more bluntly, we need to hurt the economy. Yeah. We need to hurt employment. That would be something that would not shock me, is him to say, we need unemployment to go up. And maybe he'll use different words, not exactly that. But at the end of the day, he needs to hurt employment because the labor market's too tight and inflation's too persistent because of that. Yeah.
So for me, it goes dot plot, Q&A, or whatever you want to call that after. Right. And then the Q&A is important because for me, it's like, because again, to me, it's like, does he say, I'm going to cause 1 million unemployed? I mean, he will never say that, but does he say something like, we see unemployment rising to 4.5%? Well, that means 1 million people. Yeah, 1 million people are going to lose their job.
Wouldn't shock me. Wouldn't shock me. Now, I'm not commenting on the numbers, but I would not shock me to have him say that unemployment will go higher.
Yeah, and he may put a number like, hey, 4.5, 5, whatever he's going to say.
I mean, you and me have been looking at each other and saying, like, what doesn't the market get? Yeah. What doesn't the market get? We've been saying this for 5 months, whatever the number is. Yeah. On our social media page, we've been telling people ad nauseum, be cautious, be cautious, be cautious. And then people said we weren't crystal clear, and we came out in the middle of the year and said, listen, this is what we think. We think stocks are going to not be a good investment in the near/intermediate term, and here's why. Yeah. And it was like, okay, now we get it. But they're very clear that core inflation is what they're focused on, and they want to control that. And they're nowhere near it at this point.
Yeah. So the last thing I'm looking for in the, conference or Q&A portion is, I hope somebody asks, or maybe he does this in his prepared remarks, is he says when he thinks they can be at 2% inflation. And what I hope he says is 2024 or 2025, because we have to take the Fed pivot off the table next year. I could see a plateau. I could see rates getting to terminal rate and staying. I don't see a rate cut next year. Mathematically speaking, getting inflation to 2% next year is hard to see possible, just with everything going on.
Yeah, really, really tough argument to make that we're getting to 2% or anywhere in that ballpark next year. I do disagree with you, and I've been on this side of the fence for a while, and you've been right over me for sure, that they will end up cutting next year, because I think that the stake will be driven deeper and deeper into the economy, and things will start to wither in a meaningful way. And I think that they will recognize that via unemployment going up, whatever it may be, and you'll see them start to cut rates on the other end. Yeah. I think that's what history says is likely. Now, that's not to say it's going to be repeated by any stretch, and we don't know how persistent this is going to be. And we talked about geopolitical risk on our first segment. What does that do to it? There are a lot of unknowns out here, because the geopolitical risk in the Far East right now is real, between China and Taiwan, between China, India, and Russia, and what the relationship is there, and the full shut off that Europe is doing to nat gas coming out of Russia here in the next month, or whatever the date is at this point.
Yeah, it's as I think I said at the end of the first video, I've never had a more uncertain 6-month period. I've been studying the economy for a long time, and generally you can see where the dominoes go with slight variations. I see 7, 8 different outcomes based on different things. It hurts my head to think about. So
yeah, and then we obviously look at the spillover into the the markets and the equity market, fixed income market, et cetera. But when you overlay not not the Fed funds rate and their movement there, but when you overlay their announcement of the quantitative tightening process. So
yeah,
let's rewind back to COVID. So COVID hits, the Fed immediately says, we're going to ease. We're going to, cut rates on the one side, and we're also going to spill money into the market. So the Fed's balance sheet between what it was April of 2020 and January of 22 went up $4.5 trillion. It went from 4 trillion to $8.5 trillion. And we look at it, and what happened to stocks? No shit, they exploded in a positive way.
Yeah.
And then what happened though? January of 22 came, and they made the announcement. January of this year, they made the announcement they were going to begin letting bonds roll off their balance sheet. And what happened? The market precipitously came down. Then what happened was in June 1st, they actually began the roll-off process.
Right, very small.
Gap down further. And then what happened last week? The pace of the roll-off doubled.
Yeah. It's September 1st.
It's like, guys, when you overlay the dates of the announcements and the beginning of the selling and the beginning of the doubling, the market perpetuates downward like in lockstep. And I'm not saying that that happened in a vacuum and that was the only thing that drove anything, but at the same time, it's like, guys, don't fight the Fed. The Fed is not only raising rates, but they're also letting securities roll off their balance sheet.
Yeah.
Usually when the Fed is fighting inflation, it's in a rip-roaring economy. We all know that that's not what we're in right now.
Yeah.
And so it's tough to just say there's going to be this big reversal in the economy, in the stock market, if the Fed is just going to continue to stand on the brakes. They don't have a control on inflation right now.
Yeah.
It's tough.
Yeah, folks, Taylor's going to be coming back every week. We're going to be talking about what's really going on. It's these next 6 months, having him here as a 10-year Wall Street veteran is going to be very, very helpful. I know, I appreciate it. I'll be learning a lot. You put out stuff daily that people have to check out. Where is it?
Yeah, check us out at Life Goal Investments. We're covering stuff on Instagram. We're covering stuff that's macroeconomic and market oriented. It's not life goal information about our product. It's about what's going on in the markets and trying to distill it down into layman's terms that anyone can understand.
Yeah, you do an amazing job of that, by the way. It's not easy to do. Thank you.
I appreciate that. Thank you for saying that.